We are a technology provider. Our core objective is to work with advisors who are saving registered. The difference is just like going to a doctor versus going to a quack in our minds. And we are trying to figure out the best ways which can make investment journey easy for people such as you. Right? So that is what Outperform is.
Here we are talking about real advisors who can give you advice and they have a registration to give you the advice. So here we actually serve them. We as Outperform we basically serve them. Now I will introduce Mukesh to you. Mukesh is basically working with me in Outperform. He has got experience of 15 years in different areas, basically, more than 15 years in different areas. Now he has been with McKinsey, he has been with Flipkart and other firms. He's kind of a ex-HBS level as well. So I'll introduce Mukesh to you. Mukesh, maybe you can take it forward from here.
To take control of financial matters in their hand and want to seek active counseling with advisors who are saving registered. And like as Pratik mentioned, a lot of people who would give advice over YouTube, some of them right, a lot of them wrong. Right? So with that, the objective for the session, as Pratik outlined, is to talk about what are the different asset classes. And we'll start with the very basics. What are their return risk profiles, right? What is right for whom? We'll also talk about what role can technology play in helping you achieve your financial objectives. And then we'll also talk about some of the very important themes, right? Like what does it mean for women leadership in financial matters? How can women take more of control of their financial matters that they should care about? Right? So that is all that we'll cover. This is an educational session. We will not be taking any specific names in terms of what is right, because it changes for everyone, for every individual. If anything comes up, it is just from an education perspective, it is not an investment advice. So we just wanted to make that clear. Now in terms of the esteemed panel of guests, advisors that we have, first I just introduce Ratna Sri. She is a SEBI registered advisor and she works with a lot of clients in order to help them grow their net worth by thinking about different asset classes like from debt, mutual fund, equities, etc. And we are so glad to have you here with us, Sri. Chanpreet, on the extreme right, he's also a SEBI registered advisor, a data scientist, an IIC graduate, and his own approach to investing, of figuring out how to navigate volatility while maximizing returns through specialized investment models. And that is the expertise Chanpreet brings to us. So thank you, Chanpreet, for joining us. And to my right is Abhimanyu. He's a hedge fund manager. He's based in Dubai. And his focus is more around high growth strategies, going long and short, through an algorithmic approach of trading, right? So we'd love to know more about how that world works. Thank you, Abhimanyu, for joining. Pratik has already talked about, why don't you just give us an overview of what are the different asset classes that are available for Indian investors, and how should someone who is like a beginner think about the risk return profiles and what is right for their Indian investor?
So let's just talk about asset classes. I think there are a lot of asset classes available for people to invest. Traditionally, I think all Indians invested in land and gold, but doesn't, so that's your real assets. And the fixed deposits is again, very comfortable. It is an asset class, and these are three things every Indian is familiar with. But going beyond mutual funds, and if you look at mutual funds, we have more than 2,000, 3,000 products available which cover all asset classes, if you ask, within that framework. So there are a lot of asset classes available within the mutual fund framework. Beyond that, you could go then individuals. So you could do bonds, you could do equities, you could do private equity, you could do AIFs today, you could do P2P lending. I mean, the number of products is, I think everything that you have across the world is available to the Indian investor today. And of course, we also have the flexibility of investing across the world. So even that is available. So there's nothing that is not there. I think lots of asset classes available. In terms of risk return, what exactly was your question?
So the perception you have is that with FD, there's a lot of stability. it's backed by Bharat Sarkar, and but at the same time, probably the returns you'll expect would vary from time to time, but probably you'll get 5 to 7, and then there's a taxation implication to it. Versus, let's say, if you go for mutual funds, what are the kind of risks that you're taking by going there, and what are the kind of returns you're getting? So if you could throw some light on what expectations should be.
When I talk to people, I usually tell them for every asset class, there are 5 parameters that you should look at. When you, even if you don't go to an advisor and you want to do it yourself, 5 parameters that you ask a question about every asset class. The first is, what is the risk? When you say what is the risk, it means how down can it go is the first question you need to ask. Not how up can it go, but how much down can it go, and can I deal with that downside? Okay, so that's the first question you ask. The second is, of course, the return. Then how high can it go? Because that's what gives you the volatility of that particular investment product. Then you talk about what is the liquidity. If I want my money tomorrow, or if I want my money, how many days will it take for me to get my money back? The fourth question would be, how long should I be invested in this product for me to see results? Like when you do real estate, you don't buy today and sell tomorrow. It doesn't happen. So you buy and you hold. And we all know that about real estate. But the same applies for other products as well. And of course, the fifth most important parameter is, what are the tax aspects of investing in that particular product? Most of the time you forget to ask that question till it is time to exit. So these are the 5 things you must ask yourself and ask the person who's showing you a product in terms of your comfort zone.
Got it. Now, we know quite a bit about mutual funds, but from an equity perspective, when should we go for equity? Who should go for equity over mutual funds? And is it possible to consistently outperform in equities through careful stock selection? So, thoughts on that?
Careful stock selection is the key. Who's doing your stock selection? What background do they have? And what research tools are they using? What processes do they follow is the key. And yes, if you get the right process and you're working with the right people, you can outperform. Otherwise, it would be available to you as an asset class. So that is the key.
I see. So another thought which comes to equity markets is that, and there's a saying, right? Timing in the market versus time in the market. So for an investor, how should we think about what is the right time to enter the market? And like these days, I'm sure all of us have heard the conversation that Indian markets are at all-time high, but all-time high seems to be the new routine, right? So when do you think about entering the market? And the other side of the question is, when do you think about exiting the market, right? So maybe Chandri, over to you, right? How do you think about this question of timing the market, entering, and how do you think about the exit strategy? Maybe if you could cover that.
Okay, so maybe let me first cover the exit part of it. Because everybody knows to enter, the bigger question is when you really exit the market, right? Okay, so this is how I, in a very crude way, I put it, right? Nobody knows what is the right time to exit the market, right? Whoever claims to be is lying, right? Whether an advisor or whoever it is. The whole idea is that when you actually invest your money, it's always with some goal, right? You might be investing for your retirement plan, for your child education, for maybe an international vacation, whatever it is. 99% of the time, you're putting money into market, it's for a purpose, right? The best time is actually your purpose is meant just
right? There is no perfect time to say, okay, markets are going to crash or it's going to go up. You are always going to exit. Second thing is, the way you invest, your investment philosophy, at times actually changes. So fundamental hypothesis around which you actually invested actually have changed. One of the examples is a lot of people have invested in defense stock because of a lot of government being focused on that, defense is the new thing, we are going to be an Indian export-based economy. So the whole idea is that you invest in a market, assuming something fundamentally, and this fundamental assumptions no hold true. And it's the other reason of, you should be exiting the market. Second is, so the first is very clear, goal-based. Second is when fundamentally your assumption changes. Third is when your risk appetite changes. Today you are getting a good job, you are getting consistent salary, so your risk appetite is much higher. You might be aggressive, you can put in small cap, mid cap. But tomorrow what if you see a job insecurity? Or maybe you and your wife are earning and now one of the partner is not taking money. So your risk appetite has changed. So when your risk appetite changes, the reason you invested in those maybe aggressive stocks, you might have to kind of lower down your risk appetite. So either it changes, your financial situation and risk appetite changes, do exit it and identify now what is the right asset in what composition that you should go for. Your goal is reached, do exit it. And the third I say is you assume something that this is what's going to happen in the next 1 year, 5 years, 10 years. Now that does not go to just exit. These are like a logical way of exiting it, but somebody trying to time the market and say, you know what, this is the peak and now it's going to fall and let's go and exit it. Historically, if you will notice that typically does not. So that's the part on the exit part. And on the entry part, I think that's straightforward. If you are investing, I'm not talking about put and portfolio, you are investing it for a longer purpose. Whatever efforts you put into time the market, it's not going to be the right approach. The best time is you enter right now. Because you are playing a long-term game, it is going to be average.
Demands on that, right? So, if somebody got a lump sum bonus, right, would you advise to go all lump sum now or stack it over a period of time, and what should be that period of time? So, on entry side, how should somebody who got bonus, big bonus, right? How should they think about it?
So, I'll cover it in two different ways. One is if you're getting a big bonus, and depending on your risk appetite, first thing of where you really want to put that money. So that's a very, very different question on the asset allocation side, where you should be investing. Other question of whether you should invest in a staggered approach or one-time approach. I believe in a one-time approach, and the reason for it is in the longer run, anyhow you will get staggered approach. Let's say you stay in the market for next 5 years, right? Even if you're staggering every month, let's say you got, for example, 100 rupees as a bonus, 20 rupees you are investing in Jan, Feb, March, April, May. Over the 5 years, when you will notice, because actually a one-time investment that you made in the first half of the quarter and the 4.5 years, because entirely you were actually investing. So anything that you're planning for long term as an investment purpose, the staggered approach does not make sense. However, what does make sense is you want to play safe and you say, okay, this is 100 rupees I have got. Let me invest 15 in equity. 15 in company sort of an FD because you want to be secure from a job perspective. That's a very different ballgame when you are completely investing in very, very low risk, low return game, which is completely safe and that's very personalized to your financial situation. But if you want to invest in equity and you have 100 rupees, it does not make sense to just divide it over months and can do it because in the longer run it would look like when you look back you will realize you're actually invested in the wrong times.
So, changing the gears a little bit, right? So we keep hearing about strategy-based investing and dot-com trading and hedge fund kind of stuff, right? So maybe this is a question to you, right? So the focus is on consistency, right? So all these strategy-based investing, can they consistently outperform the typical traditional equity investment? So how should we look at the consistency aspect?
If you ask for consistency, I would not recommend equity as a product to invest in because most people look at consistency from a monthly perspective, right? But these particular asset classes which we are discussing are more on the yearly. So if you just change the lens from weekly to yearly, they are consistent enough, not consistent and not guaranteed or anything, but they are consistent. So for example, in the last 20 years, Nifty, which is representation of the India market, has been down for me 3 years. I think in 20 years, we can give 3 years to Nifty saying, if you score 70 out of 20, you are still good enough, you are consistent enough. But if we are assuming that, okay, no, we should get it every month, I think that's a wrong expectation to set from this particular asset class because the kind of risks it has, it cannot give a consistent return on a monthly basis. And anybody who's talking about that is, I think we should stay away from those kind of things. Because even the most sophisticated strategies from an investment or from a little bit longer perspective are very difficult to get consistent return on.
So what you're trying to think is that consistency is more determined by the period you look at. So it is fair expectation to expect consistency over let's say annual period. But the question is not to begin with that you start expecting a weekly or a monthly kind of fees. And these strategies and these are the things which in the annual time frame you would expect some sort of a consistent.
And then there was the second part about outperformance. So what happens for any kind of outperformance? There is an extra risk that you are carrying. Right? Now, outperformance, if you are measuring in return, that okay, Indian market gave me 10%, somebody has given 15%. So for that extra 5%, somebody has taken extra risk than the Indian market. Otherwise, it is not possible. Statistically, you need to have higher risk for a higher return. It's not possible to lower the risk and get higher return. Then everybody would just do that. So when somebody promises you or talks to you about an alpha, ask them about the risk. That okay, if you are promising this much alpha, what is the extra burden or what is the extra risk that I will carry? Mostly it's something where if a market moves downward by X%, your portfolio will move down by a little more than that, or much more than that. And you have to know that before committing to that outperformance. If you are taking more risk, it is definitely possible to outperform the benchmark considering, I am considering benchmark as which is the Indian dominant.
So diversification is such an interesting thing, right? So how should an investor think about diversification? How do we think about correlation between different picks you might have made? So could you elaborate more on this aspect?
So like I said right at the beginning, right, you look at 5 things when you look at a portfolio, investing in a product, your risk, your return, your liquidity, because these are the things that an investor needs. So when you diversify, as long as you keep that in mind, at least, I talk about all asset classes all the time. So which is why if you keep that in mind and then you diversify your portfolio, you will find that when you have a liquidity need, you have X amount of money. When you are going for a long term, you have your X amount of money planned. You're paying taxes, but you're also saving on taxes on some front, or you're generating larger returns net of taxes. So when you do things like that, you will find that you're overall very comfortable, because when you need the funds, like we said, goal-based, the funds are there for you.
So almost like those 5 parameters you said, and then you look at all the asset classes and try to create a mixed picture across that.
So when you're talking about diversification, I think thinking of investing in defensive sectors is very, very important. So what I mean by that is banking, IT, these are the sectors, if somebody in the US, just change 0.25 of your Fed interest rate, these kind of, the volatility in these stocks are very, very basic. But sectors like healthcare, utilities, and defense, they are less dependent on what these short-term changes are happening, but they are more on the long-term side, and that's why they are defensive sector, in the sense that when the market goes south, these sectors are more stronger, right? So when you are thinking about diversification, you should have stocks for banking, IT, which most of the time looks very promising, but also think about stocks from defensive sectors so that your portfolio should be diversified. That's point 1. Point 2 is there is an assumption. You invest in more mutual funds, you are more diversified. Or you have more number of stocks, you are more diversified. That's a very long assumption, right? Because a lot of time, it's all these group of stocks are actually associated with one sector. Talking about true diversification, when you have multiple assets which are independent or negatively related to each other, that is where diversification starts pitching in, right? So, 3 key points that I want to cover. One is the defensive sector investments, very, very critical for diversification. Second is, whatever stocks you have in your portfolio, they cannot be related to each other, otherwise you are not truly diversifying. And the third important thing that I want to cover about, diversification is, again, on the large, mid and small cap. Large cap is, stocks are moved by global scenarios. Mid and small cap stocks are usually moved by, how companies are doing.
So it is not a number of stocks, but actually being mindful about how they are correlated with each other. All of that, just having 100 stocks is not diversification. I know the gentleman in the purple shirt had a point. Is it related to the risk discussion? Yeah. Please go ahead. After that, we'll open up the panel discussion for more Q&A, but let's take this point from the gentleman.
I agree with your point, like one stock is more than extreme example to give it sort of an idea, but I think that holding like relatively lesser number of stocks, but with more.
5-10 stocks, if you are very fundamentally strong, you have studied the company, you have studied the research, that maybe, in next 1 month it might not go up, next 1 year it might not go up, but in the longer run, this company has a scope, it does make sense, and that's how exactly fundamental investment needs to be. So I completely agree with your point.
Great. On the risk aspect, right? We have also heard about these fancy terms of hedging techniques using options and futures contracts, right? So, but we also probably have heard that the cost involved, right? So maybe Abhimanyu, if you could throw some light on this cost-benefit analysis
of these hedging techniques involving options and contracts?
So when we are building a portfolio, I think Chandra already covered it. We have a very good hedge of gold against it, where we deploy a certain amount of capital in gold or large cash to protect against some potential downside, because generally it's been observed where equity markets fall down, gold goes up. So your overall portfolio is balanced. What has not been talked about a lot is we have a certain kind of insurance available to us. It's called put. So for an investment that you make, say you buy an Nifty worth 10 lakh rupees, you get a put for around 2% of the cost. Where if your Nifty falls by a certain percent, the put almost covers the gain of put, which is an option contract, almost covers the loss of Nifty. So our portfolio is net no change in case of a downfall. So I would not recommend directly buying puts, but I would recommend taking a slightly deeper dive into a kind of, you don't treat it as a trading, you treat it as an insurance. So for example, on every 1st of January, buy a put which expires on 31st December of that year, and forget about it. It's like a health insurance for your portfolio. It expires on the year. If whatever happens in the market, nothing will happen to your portfolio. The downside of doing that is, whatever your portfolio performs, 2% is the cost you are giving for the protection. So you have to ask yourself whether the 2% is something that you are okay with paying for the peace of mind. Certain people are okay, certain people are not okay. But it's a hedging choice which has not been discussed a lot. Gold is a very widely discussed, large caps are very widely discussed because they fall less than everything else. Put is something which protects a portfolio from a very sharp downfall, because the value of put rises drastically when markets fall down.
Actually, changing the gears a little bit. We talk about women in finance, right? And we know that that is an area where only a little work has been done and a lot needs to be done. So, what unique challenges women face when it comes to managing personal finance or even investing? And any specific strategic investing strategies or products that probably we can recommend when it comes to more women participation in managing these finance matters? And Ratnaji, I'll ask this question to you, given your expertise in this field.
Thank you. So I, just for others to know, my brand is called Her Money. I believe in empowering women, and that's what I do with 90% of my clients are women, just to expand on that one. So when I started on this journey, I think even amongst advisors, I was one of those, I was walking to a group which was full of super people, and I was one of the few 5-10 women who were entering. I have to say the landscape has changed a lot since then, even in terms of advisors. So, very happy that change is happening. I think women, and I think men as well, carry a burden over generations, which is very, their mindset. First, I would say it's the men who carry the burden. They've been taught and brought up to believe that they have to be the sole breadwinner, and therefore, it's their job. And because they have been brought up to believe that, they very often, in a very protective sense, possibly tell the women that it's not your job. So women have been brought up to believe that it's not their job, they needn't do it, they shouldn't know about it, and that it's too complex for them, then they could use their brains for better things. That is how it is. That's part one. Part two, in fact, yesterday my partner was talking about it, probably very funny. So, we have this whole mindset thing about talking about money is a bad thing. So that is the mindset that we've grown up with. So when you bring about the subject of money with women, it actually is something which affects them very deeply on a day-to-day basis. But because they don't have conversations about it, or they are not brought into conversation. So I think money is not technical at all. It's very simple. It's not as basic as your cooking. It's as basic as health. As simple as that. If we talk about health and generating alpha, it's the same thing as being super fit.
Right.
It's as simple as that. So those are the mindset issues, and I have so many. In fact, it's a standard statement when I talk to so I think we need to stop making them feel that it's something complex. We need to stop making them feel that they're not included. We should encourage them to come and speak about it. And they're pretty smart about it when we start working with them. And many a times I've seen them being much smarter than their spouses. So neither men are also not terribly smart about finance.
Right.
It's just that they carry this burden on their head. I have to do it. You don't have to. I think if you include your woman, you just might do it better.
So great points, right? So involvement, getting involved and overcoming those traditional mindsets probably is the start, is the first thing to do. But then, what are the first few steps? Let's say if people, like if women are listening to us, what are some of the initial steps that they can take to start this journey?
So I think because they come with that mindset, I also meet women who love to just spend it off. So the spouses come and tell me that Rajna, please take care of them. So because again, like I said, like if they already end up spending it, and they're like, okay, he's still learning it. So I think first is that mindset. You shift that mindset. The first thing I would say is get into the habit of budgeting. Get into the habit of saving. And again, a lot of the savings goes into FDs, and then they say, oh, I need to see my money, otherwise I don't know what to do with it. I need to see it. So a lot of the time they face technical challenges about investing because they find that the money has gone away somewhere and we don't know where it is.
Yeah.
It's a very fearful situation for women in particular. They feel very insecure about it.
Right.
So the first thing I actually do is teach them not just how to invest, but show them how accessible their funds are.
Yeah.
That how easily they can transact if they want without depending on their spouses, without depending on even me as an advisor, because I tell them this is where you can immediately pull out of your account. Then you don't touch it. That's the beauty of working with products.
So budgeting.
So I think starting is the budget, creating a savings plan, and showing them the technicality of it because they really struggle with it. Not because they technically challenge a lot of them, because they don't have the time and they don't want to spend that time.
Right.
So when you take them through it, they're very savvy, and once they learn, they are diligent.
Right.
Once they learn, they are diligent. So that's the thing.
So that overcoming that curve.
The initial hesitancy to get into it is the biggest challenge. But once they get into it, they are super efficient.
Another question which comes to my mind is, like we live in Bangalore, right? So technology, new age data, right? And so there's a fundamental style of investing and the new age data-backed style of investing, right? So maybe Chanti, I know that data scientists come from IISc, so talk about, give us some examples of the impact of these different philosophies. First of all, how do they differ and what kind of impact they can create?
Okay, so one area that I love talking to, right? So in finance, in equity especially, everything boils down to one thing, right? Right information at the right time. That's one thing when it comes to talking about technology, talking about AI is how quickly, how smartly you can access that information at the earliest. And that is one of the reasons, at least not now, but just 2 3 years back, if you talk, everybody talks about institutional investors are going to make more money and you are going to lose money. The reason or the fundamental of why everybody was saying this is because institutional investors have deep pockets. They can have the access to the technology and the data that is required, and by the time that information reaches to you guys, it actually doesn't work, right? So the role of AI, the role of technology, maybe I'll explain with a very, very simple example, right? I have done once I did a YouTube video, but I took the same example I took about a copper commodity, let's say. So you are an economist and you somehow figured out a pattern that whenever Brazil and these South American countries unemployment rate goes up, that basically means copper price is going to go up. And there is a reason for it because all the copper mining actually happens in South America. So if people are unemployed, that means mining is actually not happening there. That means in a short term, in the next 1 month or 1 year, the demand, the supply side is more constrained. So it's a demand and supply game. Copper prices are going to go up, right? So you as an economist made this statement. And you said, oh, this is a smart idea. Every month you wait. You see the report, if the unemployment rate is going up, you just go and buy copper and you make money out of it, right? Now, this report comes on a monthly basis. Now, somehow somebody observed a pattern, saying, oh, when the report is coming out, there is a lot of volatility in copper prices. So, somebody observed the pattern and they said, okay, let me make money out of it. What they did is, the moment report comes out by the Brazilian government, they integrate it with the APIs, that they get an information, process it within seconds because you have an LP and everything. Within seconds, they have the number, and they connected that APIs with the broker API. of an interactive broker or any US broker, right? So the moment report comes out, within milliseconds they access that information because it's open now, and within 1-2 seconds, the trading is already done. So by the time the economist who was actually making money earlier went to the and go and buy copper, the prices would be already up. So even though the information is right, now he cannot make money out of it, right? So what I'm trying to say here is that it's never about the right information in the market, especially in a short and medium term. Long term it does not matter, but medium and short term, it is the right information at the right time. The moment your technology comes into picture, you can access that information. Very granular, the role of AI here is that it is not just one information. There is every minute there is so much of information that is flowing in. You cannot write manual rules, right? You need to build some statistical models or machine learning models to predict those things, right? Because you have to predict it in near real time, just do it as quickly as possible. Because that's the only way to make money consistently in a short and medium term. Is right information before everybody gets it. So the role of technology and AI is to kind of bridge that gap so that you can take actions much faster than others, so that you can actually make money. Others will definitely enter there, but they will not get the price that you will get, and that is where the real alpha is created, right? But having said all of these things, I think in a longer run, if you are a value investor or fundamental investors, in the next 5 to 10 years, I think those short information still might not make sense. You can still use the technology to kind of collect so much of information these days. You want to study a company, you can actually do, what are the, Twitter to Facebook to all the data you collect, what the people are talking about, to try to understand, whether they're able to satisfy their customers and all. So there is a whole bunch of things that, technology can help you with. Eventually, at the end of the day, these are just access to right decision making, and most importantly, quote unquote, at the right time. That's what the real goal is.
So right information at the right time, both have to come together for you to make good returns in the short to medium term.
And one last aspect which is very subjective, just add on, is that it's like nobody is dumb enough not to make money in the market. Most of the people, or rather I'll say at least people who I have met, everybody is smart enough to invest their energy and make money out of the market. What really does not work is the psychology. So when somebody says, I have a 20 years of experience versus somebody says, you have a 2 years of experience in the market, trust me, if you really drill it down, the 20-year guy would have even more simple logic than this 2-year-old guy, 2-year experience. The whole idea is about the psychology part of it. When markets will be bad, will you exit? Will you panic? Will you be greedy? So technology, one other aspect that I have realized is, it tends to test, you can test things how it is going to work in last 10 years if you know coding and technology. And at the same time, given now you know what can be the downside and upside, you are more mentally strong to stay in the market if you are using a technology-driven solution. So I always say that an algo trading would be always smarter than a human trading. Not at all. A human is building an algo eventually, right? But the whole idea is that technology, automation helps you stay consistent, be patient, don't get into those trap of panic and greed and all. And that is also one of the most underrated and important aspect of making money in the market. Is staying strong, not panicking, not just something has happened, let's take money out of it, right? So those I say stupid things does not happen when you try to automate stuff. And that's also one of the ways to control your psychological behavior, which more often than not will make you lose money in the market.
So removing human biases. So another challenge which comes to our mind, right? Keeping hot time or discuss time right? So what is the role of technology in terms of making some of these returns more accessible? Maybe if we can talk about from this perspective, right? That typically you have a mindset that it needs significant time and attention to pass time making, right? So what role can technology play there in making it more accessible to everyone?
Overall, civil has come up with a very beautiful framework where they have all the procedures in place where Jalpreet and Nasri are registered. So this is a framework they have, which is somewhat verified, people can trust. So I think if people do not have the time, they should be willing to delegate it, right? So say I am suffering with something, it's a health issue. I am not the health expert, so I delegate it to a doctor. Similarly, I might not have, say I am a developer, I might not have experience in finance. I can delegate it to someone whose full-time job is finance. They might try something to it, that is okay. because it is off your plate. Now, doing this, there are multiple ways to do this. A traditional way to do this, where people might call you, people might be more involved with you, and then there are technological driven ways to do it. So, the technological driven ways to do it might be slightly more efficient than the traditional ways. One of them which Outperform is building with the advisors, where you can just accept the advice which the advisor said. Yes and no. And all those advice will just reflect in your broker. You do not have to go verify, check what happened, where happened, did it really happen. All of that is taken care for you. Similar things like this, only this is another example, where most of the things are taken care of. All you have to do is say yes. Right. So I think it's delegation in a more beautiful fashion, where you have the control to yourself, but the control is being guided by someone who knows that stuff better than you.
Just looking at the clock and we have only a very few minutes left, but I can't be in Bangalore quietly and not talk about real estate, right? So, what is the role of real estate in someone's investment portfolio? When is it a gamble and when is it not? So maybe Ratnasri and Chanti, if you would like to chime in on that.
Most people in the financial industry say real estate should not be invested in. I am heavily invested in real estate, just to disclaimer. But so real estate is something which, in my experience, I won't just talk about my, what I believe in, is that people have an emotional attachment to it, and therefore sometimes removing it from your portfolio doesn't really help. So, which is why, so I go with clients depending on what is their level of emotional attachment to both gold and real estate, because you can't really take it away from that. And yet, then slowly move them to make the portfolio a little more holistic to ensure that everything else is taken care of as well. So, in terms of risk return, what it means to have a real estate investment is something which I think is more important for people to understand. In terms of return, the kind of product it is, it's a very long-term kind of product. So, you have to understand it as a long-term product and not look at some short-term issues with it. In terms of return, it gives you it is capable of giving you good regular return. So I think when you pick a real estate product, you have to analyze what is the purpose for it. Unlike other products which are much easier to activate, like you can enter and exit very quickly, this is an illiquid product. It's a very long-term product. And the pricing is not so readily available. It's not what you read, you open 99 acres and this price mein ye wala apartment bik jayega, waise nahi bikta hai. It's finally the negotiation on the table when you kind of just nod your head and say okay and then it gets sold, right? So it is not what you think it is.
Right.
Even your rental return, it's not like, oh, खाली 5% मिलता है. किसने बोला? कहाँ से आया? So those are general numbers, but eventually for you, it is what you have negotiated. So everything here is negotiated. Remember that the price at which you buy can be negotiated. The price at which you sell can be negotiated. The rental agreements can be negotiated. How long you leave your real estate free, unoccupied. Sometimes it's your bad manners which can lead to it. Sometimes it's their bad manners that can lead to it. It's a very humanly driven product. So I have had the opportunity of managing my own real estate in very big stories, and I've had issues when I've worked with clients when I've had to advise them as to how to deal with the situations of clients, and it has helped clear up the problem. So the product is very, so that is when you come into regular real estate, like the residential real estate, an apartment or whatever. You could do commercial as well. Now, of course, you have many other opportunities because you have REITs and so many products available under that, and an opportunity to do commercial real estate. Again, then there is the maintenance and the quality of construction. There are so many aspects that one has to look at. It's a complex product, so you need to either work with an expert who really knows it well, or then it's a risk. Otherwise, it is a risk.
So first thing is sort of a disclaimer. The moment you buy your first house, I'm specifically talking about first house, nothing else, right? Don't ask anyone, right? Whether it's a good decision, bad decision, good ROI, bad ROI. It's very, very, culturally ingrained. That you have your own house that gives you a mental satisfaction. Eventually, you earn money to be mentally at peace, right? So if that gives you mental satisfaction, don't open those Excel files and say, me, MI, and this way, the interest rate, this is how it will go. Just don't do that, right? It's more of, it's a family thing, it's a cultural thing. I like see people, their parents say, oh, we want to come to Bangalore, but oh, is it not your own house? I think those things, these are intangible, nobody can quantify. It's very personal, right? Somebody who's very, very freaky about numbers and say, okay, this is good or bad, that's their call. So it's definitely, it's a very, very personal call. But I'll talk about the second part of, when you purely think real estate as an investment vehicle. Not, stay to, that you have seen school and all nearby so your kids can go to this school and there is a close by hospital. All those factors, this all just come on the first side of it, right? When you just purely on the number side when you invest, there is like, average returns, which is, you got a property, you're getting 3.5% of the property value as rent and some appreciation of 3%. That's the average return. If you are lucky, some metro project has come nearby or you have bought something near Livanali and, government has passed on, so you get, good returns there. Nobody gets extraordinary return in apartments. And there is a very, very simple psychology, right? It's a product, it's a demand and supply game, right? When markets are not doing good, anyhow nobody is going to buy your property. Because markets are not doing good. When markets are really doing good, the builders are going to increase the supply much higher than the supply that is required. So anyhow there is more supply, so you're not going to make money out of it. So eventually what I'm trying to say is extraordinary return because the supply can be much, much higher because you can build one story on top of the other. In apartments, I have rarely seen extraordinary returns. But there is definitely a perception of extraordinary returns in buying properties, and there is a reason for it. Unlike equity market where every day you open your broker account, you see, oh, this is what I have gained, this is what I have lost. You buy a real estate property, you don't evaluate every day what is the property value. And you don't know, this property is going on, let's sell it, sell it. You don't make panic decisions. You actually cannot make panic decisions. If the property value is going on, you will say, oh, wait, let it go up, I will not sell now. So eventually, the patience, the psychology part that I was talking about is much, much stronger when it comes to real estate. That you wait for 8, 10, 12, 15 years and you see, oh, I bought it for 10 lakh and today it is 1 CR. Maybe you just find the CAGR, it would be as good as just the Nifty returns over 10, 12 years. But because you are always so patient about your real estate investments, that you get the benefit of compounding. So when you hear stories about great returns in real estate, and I'm talking about apartments, it's basically the patience that has played the compounding that has played the role. Otherwise, you will never get 20-30% CAGR return like, a multi-bagger stock in some apartment. Now coming to the buying a land as a real estate, that can do magical, but beyond your control. You buy a land and some government project is coming, some airport is coming, all those things happen. Today it's X and it can be 30X also. There are stories, you need to be lucky, you need to be smart. In buying that things, you need to be lucky as well, if you really want to make money out of the land part. But now I think government has simplified with, the REITs and other that have, these regulated instruments that have come if you really want to have an exposure of real estate. Because it's not very much dependent on the global markets, it is not that volatile. The risk profile is much, much lower for REITs and other listed instruments. Let's go ahead and kind of do it. And last thing that I want to kind of conclude, that's a practical experience on the real estate is never invest something that you might need for liquidity purpose in real estate, even in a longer run. Because that's a very, very long thing. The day, you really make returns in real estate is when you have patience to say, okay, this is my property, this is an X value, you want to buy it, otherwise don't buy it. That's why people make money. When you need funds, the first thing you look at is, just liquidate your real estate. And when you are a little desperate about liquidating your real estate, you tend to always, go down on your prices, and that's why you hit on the real price. So never invest, quote unquote, a real estate investment. Of course, health and others are other reasons, but never invest if you believe that, in 2017, I might want to liquidate this and I will definitely sell it in 2017. If you have a timeline, you are desperate about it, you will never get the real market value of it. On the negotiation side, you will not be at the higher side of it, right? So, to make money, I think it's okay if you say, okay, you are not buying it, it's okay, I can wait for a year or 2 years or 3 years and then sell it. That's where, real money is being made in the real estate side of it. So that's typically a mistake, that I just wanted to kind of call out based on experience.
Great conversation, passion, discipline, all that is what matters, and of course, real understanding of what the business is that really determines your alpha.
Portfolio management service or
So maybe I should take that question. Think of Alpha Quad as something like MyGate experience for financial investments. So what we have observed is that when advisors send an advice, right, that hey, here are the 3 stocks to buy, here are the 2 stocks to sell, you would be in an important meeting. They would have sent you an email and you would only notice that the next day. And by that time, the price would have moved. So the core thesis of Alpha Quad is that just as Chandri was talking about, that the right time also matters because information moves so fast. What some analysts have shown is that investors are losing around 2 to 3% of the alpha they can generate by not being fast enough. And that is the core premise of Alpha Quad, that can we give a MyGate kind of experience where you get advice, you quickly scan through it, and if all is okay, you just press OK, and the transaction happens, right? Which over a period of time would lead to good amount of money that you'll be able to make just being fast enough. So it's a technology platform. Advisors advisors are a core component of it. They bring their clients, and the clients are able to seamlessly follow and execute their advice using this technology. So I hope that answers what Alpha Quad is.
So then how does it work for mutual funds? Like the same way?
Right.
Basically, it's like an app controlled by you would send a notification, and if you want to go out and buy something.
Correct. The idea is that if your advisor gives you advice on mutual fund, you should be able to see that advice on Alpha Quad and you should be able to quickly execute on it without spending a lot of time. So, the most of the options which are available with Alpha Quad, those are white labels. For example, your advisor would use Alpha Quad technology to provide you a personalized experience, and they can give you advice on equities, they can give you advice on F&O, they can give you advice on mutual funds, and you should be able to seamlessly execute, again just like MyGate, to execute on whatever advice the advisor had for you. So we're just starting up, it's a 3-month-old endeavor. So right now we have equities, very soon we'll have derivatives, but pretty much down the line we'll also have mutual funds and other asset classes. The core thesis would stay the same. The advisor gives you the right advice, how about doing it as soon as you can?
Creative companies in the past. So like whenever there is software, like there can be loss, right? So like what is the policy because like some bug in your software, like the client offers a loss?
So, trusting on the high frequency side, but this is quite different. So here what happens is, unlike high frequency thing where first things happens in milliseconds and things are directly traded, right, and executed. Here what happens is, I'll give an example that will also kind of address this question is, let's say I run a company on you and you are the client, right? Now, legally and from SEBI perspective, I cannot just go and log into your account and make trades on your behalf, right? And I don't want to call and call you and say, buy these stocks, sell these stocks at this price, all those things. I don't want to do it, right? Because imagine if I have 1,000 customers, it's never impossible for me to do it. So what Alpha Quad provides there is that whatever advice I provide in a very UI friendly, you will be able to see, and it's a white label platform in the sense, you will be able to see, let's say Chandrit has provided these 5 stocks as recommendation. Before clicking an OK, you can always scan and see, okay, these are the 5 things that you are actually making a trade. And you take OK. So that's point 1 in that you are scanning it. Second, once the trade is being made, Alpha Quad is going to send us a notification that these are the stocks that is being purchased in your account, and we can see from the dashboard that that because you have linked your account for 24 hours, we will have an access to say, okay, what you have only the access to say what you have bought, right? So we get a notification that all trades are being made. Now to your question of how still if some bugs come, unlike a high frequency trading where even for 1 minute you make a wrong execution, huge money losses happen. So given it is buy only strategy for now, even worst case scenario, which of course is not expected, but worst scenario, what's going to happen is for maybe 1 hour or 2 hours, you might have a wrong stock in your portfolio that will hardly have a huge significant impact, though it should actually not happen, but is essentially you're buying something and within an hour or 0.001% of your portfolio might have an impact. That's a high fine. I'm thinking from extrapolating what is the biggest risk, which is just 0.1% of portfolio here and there. Even if that bug happens, but it's also giving you a going to see and scan it, that's it.
But like you mentioned, like you guys are start that derivatives as well. In that case, that can be like.
Derivatives loss will always be part of the process. The bug is the problem, not the loss.
Yeah, I just like to understand like what.
These are two separate aspects actually. Loss can happen in any trade. A bug is a different problem, right? And we are trying to be there where if bugs is happening, we might take some steps where say we might pause the execution, we might not execute if something is identified. Or if something is there are then ways to rectify it, right? To place a limit order, you try to nullify it and all those. But as of now, we have not entered into derivatives because of exactly this reason, right? Because when we are delivering derivatives, we have to be 100% sure that the possibility of a bug has to be null. It can come. We cannot say that okay, it's a bug. I don't think any software can be ever a bug, fully bug free like that. Yes. But yes, but there are ways to deal with it. That's what I would say. First is to stop the execution. If it has already executed, to take counter positions, you succeed it along with that, and then see how it happens.
And just one line here is imagine that way. You have an alpha quark making a validation to make sure everything is done. Only then we are going to take that input and pass it on to you. So then there is a second company which is independent of alpha quark and advisory company scanning it. Then you are the third person whose money is actually being invested. So there are actually 3 people involved scanning before actually it is being executed to your account. And above all, if that mistakes happen, once or twice, and you go to SEBI and say, what, this is happening on this platform, actually our license is default, right? So there is so much at stake for us to not make mistake, and that is why, given, it has to be very slow, 100% or rather 99.9% quote unquote verified, and at 3 individual independent entities, which is our customer, an advisor, and a platform, so the chances of that is very, very.
So, there was one question regarding the portfolio diversification, I think. So, here the portfolio diversification, are you guys using like simple ML algos or the age-old efficient frontier or black return or any kind of those things, or just ML algos for the portfolio? And the second question is, will you guys be providing advisory for the portfolio, he said. So, will it be for short term or it's like a long term? And I think he also mentioned about the FNO option being incorporated in the later part. So will it be about volatility or not?
So why don't you first one?
So I'll answer it in 2 different ways. One is very specific to me as an advisor, right? And of course, then there is some dimension of this question that alpha quark can enter. So the question of FNO and all, given SEBI is in a gray area, I myself done it for 4 years, so we have a Canadian-based entity and we deal in New York Mercantile Exchange. But for Indian customers, we are very, very specific to only investment advisory without FNO. So, but then that pertains to me. At least the current products, we don't even have anything for the Indian retail, even because I'm still trying to understand what SEBI actually mean by it. So I don't want to play in a gray area, and that's the reason. So this is out of question for me. But maybe alpha quark can address that. Bhupesh will address. The second question that you talk about is diversification. And so when you are saying diversification and building a portfolio, everybody will have their own unique ways of doing it, right? Maybe if she's managing it, or Abhimanyu manages, every advisor will have its own way. So maybe I just comment on the way we try to do it in a very, very crisp, in an interest of time. We first try to stay in the efficient market, efficient frontier that you are talking about. Is everybody, somebody wants to kind of do a wealth generation, they can be on the high risk, on the side of high risk, high return, and somebody wants to be very conservative. So accordingly, based on what people's risk appetite is, ideally everybody has to be on efficient frontier, just that on different data points. And that's what we try to perceive. So when we are building ML algorithm that we kind of ask for, what we do is we basically rank stocks. And based on the risk appetite, the customer's portfolios are created. So, and this is our approach. Everybody approach, of course, will be different. So that is what I want to do. Now the FNO side, your question, maybe go if you want.
So think of alpha quark as a platform, right? It's almost like a email communication service. What is the content of that email is totally a prerogative of the advisor and the client. So as a client, you may sign up with the advisor to receive only equity advice. That is the content of the email you will get. That is what the email service is given to you.
it might be possible that you enter into a contract with an advisor who gives you advice on mutual funds, who gives you advice on F&O, and gives you advice on equity. So whenever that advice would come to Alpha Quad would transmit that advice to you in near real time. You can almost like migrate, choose whether you want to execute or not. And once you have taken that decision, the platform would make sure that the execution happens in a very short period of time without any error. So the platform would be competent to handle all of these things, right? So that's the idea. I hope that answers the question about F&O that you have.
Your experience, let's say in the last 1 year, 2 year time frame, what is the return that you have normally generated from different portfolios, maybe different kinds of portfolios? What is the return that you got with clients on the market?
Okay, but before a disclaimer, before saying kind of dance on our head, is that it's all subjective, there is no guarantee. So we launched our portfolios on small case last November. So we have these model portfolios we have is large, mid and small cap portfolios. Now we are launching something called clean energy portfolio. So these portfolios, first of all, markets have really good past November. So I think on an average, all these portfolios individually as well has beaten the benchmark by around 10 or 11%. The large cap beat by 10-11% in last 8 months. The mid cap I think is again beating by 7-8% and small cap by 12-13%. But then of course this is like just on the historical 8 months of life performance. Having said this, given things are on small case and others, we are very frequently rebalancing it almost on a quarterly or a monthly basis. It's fair to assume your 1.5% in the entire year will go as transactional costs, FTT, CTT, all those charges, the depository charges. So I think it's fair to assume that it's 1% less than, because eventually what matters to you is what you get in your name, right? Not the overall return. So that is a 1% loss we have kind of discounted for.
This does not allow us to talk about returns, but to talk about what. So I think a client on an average who's been with us for more than 5 years will generate a return anywhere between 18 to 25%. So depends on their CAGR, we're talking about that. So they see it because it's not nothing that we have done. We have just stuck to what we believe in, and we just stuck to what. And honestly, even I did not know it would generate like that. Even we're just watching. Our job is to just watch their portfolios and make sure that they are safe and they are achieving their goals. And the markets have done well in the last year plus, so it's showing fantastic returns.
How is it different from HDFC Bank's?
Sorry?
How is it different from HDFC Bank's passive investing? ICICI Direct's passive investing?
What we are recommending?
No.
Are you talking about equity? You're talking about?
No, he has a small case passive investing and all. So
if you look, like as if you look at it on the face of it, there seems to be nothing different. Depends on how deep you want to go to understand. So it depends on who's doing your research. At the end of the day, when you're talking about HDFC, you talk about ICICI, look at the people who are doing the research and whether you are able to generate that return from what they are recommending. So it's a risk you take, saying that okay, I'm going to go with ICICI Direct, and I'm going to go with this, I'm going to go with something else. So that's a call. I still insist on this because I have seen my own portfolio now at the edge of investing.
Awesome. I think a lovely discussion. Thanks a lot, experts, for joining us and sharing your insights. Thanks a lot, audience. You have been very engaged. And with that, we'll wrap this conversation.